Think your mortgage renewal is going to crush your budget? Here's what Canada's biggest banks just revealed at an investor conference that nobody's talking about, and it changes everything about the next 2 years. By the end of 2026, nearly half of all Canadian homeowners will be renewing their mortgages. We're talking about trading those pandemic rates for something much higher. The headlines scream doom and gloom, but here's what the banks actually said behind closed doors. First, the reality check. The Bank of Canada says the average payment could jump by $400 a month at the peak of renewals. That's real money. But here's the twist nobody's covering. The D's chief risk officer just told investors that 64% of their 2026 renewals will actually see lower payments, not higher, lower. And for those who do see an increase, it averages out to just 3.5% of household income. That's manageable for most families. Scotiabank backed this up with hard numbers. They said the average mortgage payment has already risen by $200 a month since people first got their mortgages. But by next year, that drops to just $130 as more people renew at today's lower rates. But here's the thing, this isn't just optimism. The banks are putting real data behind these claims. CIBC revealed their average loan to value ratio on uninsured mortgages is just above 50%. Translation? Homeowners have built up massive equity cushions. Even their impaired loans sit at only 60% loan to value, giving them tons of room to absorb any shock. RBC dropped another bombshell. The average credit score across their entire mortgage book is close to 800. That's exceptional credit quality, which means most borrowers have strong repayment ability even with higher payments. Now, I'm not saying there's zero risk. CIBC's delinquency rate did tick up to 36 basis points. BMO's sitting at 45 basis points. And RBC specifically called out Windsor, Ontario, where the auto sector slowdown is hitting households hard. Scotiabank also noted that while variable rate delinquencies are leveling off, fixed rate arrears are climbing. But plot twist, the banks aren't panicking. They're actually pulling back on aggressive mortgage growth and focusing on quality over quantity. They're prioritizing healthy margins and strong credit standards instead of chasing market share. That tells you they're confident in the foundation they've built. Here's what this means for you. If you're renewing in 2026, yes, prepare for a potential payment increase. But with rates continuing to drop and the stress test already factoring in higher payments, most qualified borrowers will handle this just fine. The banks have essentially stress tested everyone for this exact scenario. If you're looking to buy, understand that affordability is still strained. RBC's index shows that nationally, you need about 53.6% of median household income to cover home ownership costs. That's down from 63.5% late last year, but still above pre-pandemic levels. Toronto, Vancouver, and Victoria remain brutally expensive. Ready to understand exactly how the renewal cycle affects your specific situation? I'm offering free personalized mortgage renewal consultations to the next 10 people who comment renewal below. Let's create a strategy so you're not blindsided in 2026. Don't let this renewal wave catch you off guard when the banks have already shown us the playbook. Drop that comment now and let's secure your financial future together.